One of the most common selling factor for an ETF is that they are diversified and therefore they should shield you from high volatility. The problem is, in most cases, and I will bring you the data that demonstrate that today, in most cases they are simply over diversified, and that will have a couple of negative effects on your performance. The first one being over diversification bring higher costs, especially if the fund is tracking an index and therefore need to rebalance daily. They will have a lot of hidden costs, a lot of friction in the buying and selling to minimize the tracking error of the index itself. And then the second is the fact that the more stocks you add in your portfolio, the more far away from your ideal factor exposure you will get. In the previous video, we demonstrated how having an exposure that is to the extreme of one factor will grant you higher returns with the same exposure. So diversifying it away, adding thousands of stocks to an ETF will not help you. So in this video, I'm going to bring you the data that you will need to understand how many stocks you need in your portfolio and what to do with this data and with new knowledge that you will acquire today. I'm Alberto. My goal is to find the best investing strategy on the long term using experience, research, and a little bit of data, of course. If you are ready to Jindex, welcome to Jasper's Door. Volatility. So what is volatility in the first place and what we do about it? Volatility is simply how much a portfolio price or value will fluctuate over time, and is of course is measured in standard deviation. But for people like me, first day in finance, the volatility is what makes you tick as a human being. If you see the gray line, if that's your portfolio, you're pretty much set. As in, you have something that grows in value over time, it doesn't fluctuate a lot, and therefore you probably sleep tight and you open up your portfolio at the end of the year having this beautiful 12% and something that you will see in the graph. On the other hand, some other assets, some other portfolio may be much more volatile and it will go up and down in that crazy manner that the yellow line is showing on the chart. And how will that impact you? The thing with volatility is not risk. So buying stocks is not risky because of volatility. Buying stocks become risky because you will be subject to some fight or flight response, some fear of losing your money, and therefore you will take action that will take you away from your original plan, and therefore you will incur in losses because you're now acting irrationally and you will do stuff that are not planned and you cannot control anymore. Let me actually go even deeper on this, because most of the males out there, this is scientifically proven, the males out there will underestimate the capabilities in terms of stress management, and they will not see this coming. They will think, I will be cool, I will be do things properly when shit hits the fan. But let me show you an example. If you bought the S&P 500 25 years ago, you will probably be patting yourself on the shoulder going like, I did something extremely good in the last few years and I got great returns and all of that. But volatility can hit you in different ways. For example, you've been investing in early 2000 because new year, new me, been investing in there, but now the .com bubble hits and for 3 years straight you lose money until you get down to something around 40%. The problem with that is a constant tick down of the portfolio that probably push many of us to leave the market and find something else to do. But we all know in hindsight it went well after all. So that those 7 years in between 2000 to 2007 was already bad enough and hard enough to sustain if you were to follow the overall advice and pretty much any other bank in the world that tells you to invest in the S&P 500. Of course, 2008 its great financial crisis is in you lose 50%. And now you're 8 years into your investment and you think, is this how investing works? Is this supposed to be like this? Because I don't like it, I'm afraid. And by the way, every single person in that room with you during the 2008 financial crisis will be saying to you, hey, you need to sell everything. The economy will not recover out of this. We are done with this investment thing because everything is bad. It will take an extra 4 years to recover from that, even though the interest rates were at zero. And now you are 12 years into the investments, into your investment plan, and nothing has happened. You have zero money to show for, and in fact you've been losing money to inflation out of 12 years of the investments. And what would you do? Like, honestly, 12 years you just lost money and you got two of the worst crises back to back and nothing to show for. Would you stick with it? Do you think you're gonna be strong enough to go like, hey, I'm gonna invest for another 20 years, why not? And that's the thing, like, you should be sticking with your plan. That would be sensible to do, but human behavior is not that predictable. Human behavior will go like, hey, I've been losing money out of this whole situation for 12 years. I'm fed up. I'm not going to do it anymore, which is a shame because we know how it went. Now, how do we handle volatility? Two ways: diversification and educating yourself. Educating ourselves is something that we're not going to cover in this video. We're going to make another video out for it, or probably more than that. But anyway, diversification is what we are covering today. And the question we're trying to answer is, how much diversification do we need? How many stocks we need in our portfolio in order to be diversified enough to minimize our volatility? And to do that, we're gonna compare what is the S&P 500, for example, or what is the standard volatility of a single stock, and then compare to different approaches and different scenarios. In order to compare different scenarios, we're gonna bring in today's Jindex. A Jindex is something that you build yourself. It's a DIY investable index and is something created to meet your goals. Now, it can be investing goals. You can create something that will substitute the S&P 500, and you can go ahead and invest in that way for yourself, and we will see the benefits later. But also, in this particular case, we're gonna create an Jindex that tackles the problem of how many stocks do you need in order to invest. And this can be done very easily. We're going to use a universal approach. So all the stocks available in the data set are definitely going to be included. We're going to have a selection that is fully random. So every time we run this simulation, we're going to use real data, real stocks that have been existing and trading in the last 25 years. And every time we're gonna add up to our portfolio and make it bigger and bigger and see what is the difference in volatility and behavior over that range of stocks in between 2, 5, 10, 15, 20, 25, and all the way to 100. We're gonna rebalance every 6 months. And as I said, 2002 present day is the time interval we're going to consider for this, and we're going to iterate 5 times for each, just because the randomness will give you a little bit of a fluctuation. So we're going to average out those results. What do you think is going to happen? How many stocks do you think you're going to need in order to have a volatility that is comparable to the S&P 500, for example, or the Russell 2000? Let's go and find out. So this is the graph. On the chart, you see white dots being the values and the yellow being populated right now. That's the average. And now you have it already. This is already so clear, right? So we have something that is extremely volatile on the left side, where the portfolio is smaller than 10 stocks, and we do expect that. You cannot buy one single stock or 2 stocks and believe, oh, this is going to be fine. There's not going to be volatility in that. Of course there will be volatility. Of course. In fact, if you check out what Amazon did extremely well in the last few years, but its volatility was 35%, which in fact is matching more or less what we're seeing. We had something around 36%. But the moment we move down the line and we move like beyond 10, actually approaching 20, and after 20, the volatility of a portfolio does not really change anymore. It gets stuck in between 20 and 15%, right? On the far side, on 100 stocks, we see something around 17, 18%. And there's nothing else that happens. And in fact, if you go ahead and figure out, like, you push it to the 500s with the S&P 500, which is the most popular investment tool in the world, that is not pushing below 15% either, right? And because of this relationship in between how many stocks are in the portfolio and the volatility, we're going to push it a little bit more, and we're going to do the same experiment with small caps, Jindexes. And the reason for that is because in the last video, we did small caps returns, and we studied how much the relationship in between the exposure to the small cap factor and the returns are tied together. But in that particular scenario, we did have a big returns for the small cap, but was very closely related with high volatility. And you can relate to that if you think that small caps are the most uncertain stocks out there. Just because they're smaller, they usually have a harder life. So this is what is happening. We have a similar result, very similar. Of course, small caps have higher volatility, so it starts higher and it decreases slightly slower. So we're gonna have to wait for the 40 stocks mark in order to be below the 20%, but eventually it gets there really fast. So at 40, we already are underneath the 20% mark. So do you still think you need a big diversified portfolio with hundreds of stocks in it? Do you really need an ETF with 2,000 stocks in it in order to achieve this volatility? And I'll tell you more. If you go up and see, for example, this is a small cap iCore share, that's 22% volatility with 632 stocks. You can see it up there. If you push it even more, the Russell 2000 have a 21% volatility as measured in standard deviation. So you will not escape the volatility problem by over diversifying it. In fact, what you're gonna have is that you're gonna have extra costs in rebalancing your portfolio. You're going to have extra cost in keeping it all together, and also you're going to pay fees to the banks. Now, my idea would be approach this whole thing differently. What about building your 20 to 40 stocks portfolio that will have the same volatility of a massive index? Okay, you will have more exposure to any factor of your choice, because you can actually buy the 20, 40 stocks that actually shows maximum exposure to the value, instead of dilute your portfolio up to 2,000 stocks, or even 1,000 stocks would be definitely decremental to your factor exposure. It's the nature of the thing. And of course, you will have hyper low rebalancing cost because you only have 30 stocks, and you're going to rebalance every 6 months. You don't have to follow any particular index. You can do it because it's in your best interest. And of course, you're not going to pay any fees to any bank, which to me is a massive premium. But then if you want to talk about this with your money manager, he won't be able to talk to you about it. And the reason is because it goes against his own interests. First, he gets paid based on the commissions you pay him. So he needs to sell something that is already prepared. He cannot come up with his own ideas because he's entangled in all this bureaucracy and regulation, which have some good reasons sometimes, but not in this case. He probably doesn't know himself. Not all the professionals that have a license are really up to date with this thing. I've been talking with people very high into the banking hierarchy, and trust me, not many will know what they're talking about when they're actually talking about portfolio building and management. It's against regulation, as we said before, and also the institution that works for him will not allow it, because the institution he works for, he will try to push their own products and nothing else. They will not push for novelty, they will push for what makes money for them, which is usually very far away from what is your best interest, right? And the solution I propose for this is build your own thing, do your own investable index. We're gonna call it a Jindex. That's how we refer to it, this concept. And it gives you the maximum exposure to any factor you decide. You build it around your philosophy. You can actually build two. You like small caps, and also you like to invest in momentum if you're not happy with how those two factors interact with each other. And we're going to work on this together in this channel. So subscribe to see how every factor will interact to each other. If you're not happy, you can make two of them and have two portfolios that even if you have a small amount to invest, you can still manage it because they're very, very agile portfolios. And you can rebalance it yourself 2 hours like with 2 hours every year, you can do it easily. There is no fee involved. It's pretty much magic. Actually, not paying banks is probably what makes me happiest, because they don't really care, man. Like, trust me on this. You can disregard everything you learn in this video. Banks don't care about you. They don't care about your best interest. They just want to sell you a product, and they want to get their asses covered as much as they can. They don't think about how much money you're going to make. This is the nature of the game. Trust me on this. So if you want to learn how to do all of that, justplacedoor.com. There's no Jindex leaderboard today to be updated, but if you're new to the channel, please know that every time that we're gonna launch a video, if it's applicable, we're gonna run tests on how to run different strategies and how do they interact with each other or with new factors, in order to find out what is the best investment strategy on the long term, based on science, based on research, based on my own experience. I'm Alberto, and please click subscribe if you want to learn more about the world of investing, especially in the stock market, based on science and research. You are on Just Place Door.